Welcome back to our On Credit video. In this edition, we will talk about trade uncertainty, resilient U.S. earnings and economic growth, market vulnerability to dramatic policy change, and portfolio strategies to manage this uncertain period. We will also share the main highlights from an emerging markets conference we attended recently here in Miami. I'm going to share very high-level thoughts on the macro side. We believe there are four sources of macro uncertainty, two that are more immediate and two that are more slow-moving. First, the current trade shock. Second, fiscal uncertainty that is likely to start somewhere around summer. Third, questions about Fed independence. And fourth, slower immigration flows. Trump's policies are aimed to support growth, like tax cuts, deregulation. They have not been implemented yet and may take some time to work. In contrast, more disruptive international trade agenda has already been rolled out. Trump's agenda aims for a broad economic rebalancing to reduce the trade gap by increasing domestic production and restraining government spending. However, the shock and awe approach and frequent associated changes have led to a lot of uncertainty and volatility in markets. We believe U.S. growth is still healthy with low recession risks, but prolonged trade and fiscal uncertainty may lead consumers to spend less and companies to slow hiring. I'll shift to Rafael. Our team regularly meets with companies and other investors. A few weeks ago, you and Marcelo attended an event regarding emerging markets here in Miami. What are the main conclusions and the main points for that event?
Yes, Alejandro. I will start with overall investors' perception. Investor sentiment is better in relation to emerging market than last year. Not to say that everyone is overweight, but most EM investors are cautiously optimistic with the asset class. In relation to our company's meetings, fundamentals remain strong for most of the companies that we cover. Earnings are solid, liquidity and access to markets are okay. The only change from last year is that, contrary to investors, management is more cautious, especially with the economy. We also heard a lot about tariffs, but at least for the companies in our coverage, the impact should be limited. We still like basic materials in both emerging and developing markets, even though tariffs uncertainty remains a risk for the sector. We are also overweight in communication and financials in developing markets, given yields levels in premium to other sectors. Back to you, Alejandro. What are your thoughts on the latest U.S. earnings season?
That's great color, Rafael. Reported first quarter earnings are growing about 7% versus a year ago. That's the seventh straight expansion. But analysts have lower estimates by a larger than average margin, while 63% of companies have issued negative guidance, which is also higher than average. Blue chip companies, which makes S&P 500 an investment grade, have international revenue of about 40%, which makes the impact of trade uncertainty quite relevant. In fact, revenue and earnings growth among companies that have international revenues above 50% underperformed by about half or 1.5 percentage points. U.S. Treasury yields widened between the election and February on expectations that tariffs could fuel inflation, but declined since then given the concern that uncertainty may slow growth. The key will be how long the uncertainty lasts. In fact, companies mentioned inflation the least since the second quarter of 2021. Even if U.S. growth slows gradually, credit should perform well, given strong cash balances and credit metrics. In fact, we like U.S. high yield on low exposure to Treasury volatility and export markets. Now, let me switch to Marcelo. Do you think 2018-2019 could be a good example of how spreads are going to behave over probably this year? And what strategies do you think or recommend for tackling this uncertain period?
Good question, Alejandro. The impact of U.S. tariffs on emerging market bonds is a key question. I recently tried to quantify it in a weekly Globe publication, which was well received by our readers. I believe 2018 to 2019 is indeed a good period for trying to quantify the downside risks from U.S. tariffs. The beginning of 2018 was when tariffs were first announced in President Trump's first mandate. It is important to highlight other market-moving events were also taking place back then, such as the Fed hiking rates. Keeping that in mind, I believe the first half of 2018 is the best reference when trying to gauge downside risks. Back then, we saw emerging market corporate spreads widening by 75 basis points. Sovereign spreads widened by 100 basis points. In 2025, so far, emerging market spreads have been much more resilient and are wider by just 10 basis points. So there's downside risk if a trade war really escalates from here. Hopefully we won't get to that point. In terms of navigating this challenging environment, we think investors should stick with companies with high credit quality and with good business diversification. On credit quality, we are targeting bonds with investment grade ratings, which offer low to mid 5% yields in developed markets and mid to high 5% yields in emerging markets. We also see good opportunities in high yield, where investors can get 6 to 7.5% yields in BB bonds, which are the higher quality bonds within high yield. When we mention good business diversification, we are targeting companies with diversified exports and with a broad geographic presence. Some companies we follow, they export to several different regions and have good flexibility to change the export mix if tariffs are imposed on specific markets. We also follow emerging market companies that actually have plants in the United States. These companies might even benefit from US tariffs. In the past, we saw bond prices declining when tariffs were announced. This could actually be a buying opportunity for certain credits. Of course, investors have to always assess current events. But we think a good positioning as the one I just described should pay off over time.
Thanks, Marcelo and Rafael, very much for your great insights. I also want to thank our audience for joining us. If you have any questions, please feel free to reach out to your banker or your investor. We hope to see you next time.
This discussion is intended for informational purposes only. This is not investment research or investment advice, and no recommendation or financial advice is being given. This discussion does not take into account individual investment objectives, financial condition, or investor needs. The views and opinions expressed in this discussion may differ from the views and opinions of other departments or divisions of Itaú and its affiliates.